Alright, guys, so I hope you guys are as excited as I am to embark on this journey, which will probably last 8 to 10 hours, maybe less. I don't know yet. But one thing for sure is this job is fairly hard. I thought this was going to be easy to make this course, but there's just a lot of editing. There's a lot of things that uh, I have to make sure I don't say and piss off a lot of people. I kind of have to put on this mask, and I really don't want to do that. I try to be myself as much as possible. But if I do offend you or anything that you believe in, please don't take it personal. I am speaking from my own experiences, um, and I think that will genuinely put you in a comfortable position where you can trust what I say and what I've experienced through my journey of learning how to trade, and also my life too. Um, a lot of the trials and tribulations that I went through without a father, it actually shaped me into who I am now. So I wanted to make a course not only to teach you trading, but to make you understand my entire mindset of how I think about the business world and how I see things, how I see the reality and that we're living in. All right, so let's move forward. So let's start with day traders. So day traders are typically, they don't have your 9 to 5 employment. They're in front of their computers. They're too busy glued at their monitors during market hours, and these are people who are financially self-sufficient. So, for in my instance, I reduced my expenses to a point where I live a frugal life, but at the same time, I have enough capital that I can use along with the margin that I'm given to trade and make enough profit to cover my expenses and to actually, go to a nice vacation once or twice a year and live a normal life. I don't spend beyond my means, but if I do make a lot of money one year, then of course I deserve to spend a little bit on myself and buy new clothes, buy a better car or what have you. So I don't have wife and kids, so that's a huge expense that most of you traders that do have a wife and kid, you have a family to take care of. Um, Depending on your expenses, you will need at least $250,000 and a great trading skill set to be financially independent. For single people with enough experience and let's say $2,000 a month monthly expense, which is a very frugal life, you can make it happen with $100,000 capital, which will give you a margin of $400,000 to trade with, because you get 4 to 1 margin to day trade and you get 2 to 1 margin to hold stocks overnight. So that's enough capital, and a lot of times I don't even use most of that money to enter a single position. Every time I buy and trade, my size will range from, let's say, $20,000 to $150,000 the max, and that's taking a lot of risk on one company. But I don't want to jump the gun yet, so let's talk about what day traders are. So the potential for a day trader is to make 40 to 200% profit a year. And again, you might take a loss one year, you may make a profit next year. So at the end, you can look at the average of how well you do. Um, day traders are also called scalpers. If you hear that term sometimes, I refer myself to a scalper a lot, where or high frequency traders. Basically, you can make 200 trades a day. On average, I make about 150 trades a day. On a slow day, I'll probably make 30, 40 trades a day, which is still a lot by most investors that actually listen to me talk. They're like, "Are you insane? You actually make 100 trades a day?" I'm like, honestly, I don't even realize how I make 100 trades a day by 12 o'clock. by the time lunchtime comes along. So anyway, a day trader usually will sell everything by the end of the market's day. So by the end of today, let's say the market opened, by the end of today, I will sell everything I have. It's called being 100% cash. So if you hear the term 100% cash, that means day traders usually sell everything they have because they want to go to bed thinking that they don't have any exposure to overnight risk. So because overnight when the markets are closed, if let's say there are major geopolitical issues or any catastrophic events that occur, most likely will negatively impact the market in the morning. So you might wake up and see that, you know, some of your stocks have been sold down, and you take an immediate loss, an unrealized loss at the market open. So a lot of day traders, they don't want that to happen. Once in a while, if the market, if let's say you're in a great company that's going to let's say the earnings has just been released and you're holding um, Apple stock, and the Apple just came out with phenomenal earnings, and you think the stock's going to run higher early the next day as well, those are the times that you might consider holding a few stocks or a few companies to potentially capture that gain that might occur in the morning, early in the morning. So if a stock gaps up, and you know, if you were 100% cash the night before, well, you just missed the train. So that those are the reasons why people tend to, some traders tend to hold stock overnight. If you know, buy and sell a stock in less than a year and hold it for less than a year and sell it, then you are subject to capital gains tax of 10 to 35%. And this also goes for the swing traders or any investors that, you know, hold stocks for less than a year. Swing traders, on the other hand, they have full-time jobs, and they can actually trade from bathroom stalls at work, which I used to do. So you can trade from your smartphone if you have a mobile platform, which most brokers, they do have mobile platforms nowadays, and you can actually log into your TD Ameritrade or Scottrade account, and in a couple of seconds you can make a trade, as long as you have a decent phone connection or Wi-Fi. Excuse me. So the potential for a swing trader is to make 10 to 50% profit a year. If you are able to make 30% a year on consistent basis, and on a large portfolio of $500,000 and above, there are chances that hedge funds will actually snatch you away. So that's what they aim to achieve, you know, 30-40% profit a year. And even then, a lot of hedge funds go out of business. So again, short term, typically, you know, swing traders, they hold stocks for more than 2 days. You know, let's say more than 2 days to a few months is usually the range of a swing trader. Sometimes they call them position traders. These are the traders that will go into a position and will ride the entire trend. They will stay in the trend until you know, the stock reaches its plateau and its pivot point, and that's when they jump out. But again, so that's the main difference between a day trader who sells everything by the end of the day and swing traders that keep stocks overnight, and sometimes a couple of months to maybe a year, but that doesn't really happen. In my definition, if somebody holds a stock more than 6 months, you're not a swing trader, in my opinion. You're an investor, and investors should have their own set of rules that they should go by, and I'll talk about that later. And again, you know, there's no short-term capital gains tax if you hold a stock more than a year. And this is what most 401ks want you to do, is they want you to keep depositing part of your paycheck into this 401k fund, and they want you to hold investments as much as you can, longer term. and Uncle Sam will definitely reward you for that. So the intro of this slide says, who will you be, a day trader or a swing trader? But let me first say that, day traders are like the commandos of the stock market. You throw a day trader any scenario at any market environment, even a stock market crash, and he or she will know what to do in less than 20 seconds. And that's true. If you wake me up in the middle of the night and you throw me a scenario, I will know exactly what to do, which fear index to buy, what to sell, and it's just at this point it became a second nature. And you start off as an investor, then you become a swing trader, and then you do it so much that you're trying to trade as much as you possibly can to realize the most profit possible by the end of the market day. And I also want to state that true traders must know finance, and that's my own personal way of teaching, not just reading charts. I've met a lot of traders in my life, and honestly, I've driven across the entire North America. I visited to all the major cities. I started from LA, I drove all the way to Key West, and then I drove all the way north to Montreal, and then I drove all the way west to Seattle, and then I came back down to LA. I've met traders all over the North America through Facebook mostly, and these are people that are so different from one another, and there's yet they follow the same type of discipline, and it was very interesting to meet them. But I was amazed how many of them didn't know finance, and they just bluntly didn't know how to read financial statements. They didn't know much about gap earnings, and they just cared about their chart patterns. And I understand that as a day trader, you don't really care about the financial valuation of a company going forward. But in my personal experience, I'm always better off at gauging my position size based on a valuation of a company. If I know the company is highly levered, then I am more prone to short sell a company, which means to want the stock to go down. And we'll talk about short selling. And if later on, if I want the stock to go higher, which means if I'm long, then I am mostly trading companies that are very financially strong. They have sound balance sheets. They don't have a lot of short-term debt. They have a good brand name. They have good cash flow going forward, and there's not a lot of competition at bay. So even though on daily basis we're just all looking at charts, but in case things go wrong, you want to know how financially sound your company is, and for that you need to know finance. So I put down in the parentheses the Kate example, and I'm saying Kate example because I'm going to tell you a story what happened to me about 4 months ago. So Kate Spade, which is it's a manufacturer of handbags. So Kate came up with earnings results, and they were positive. So they were positive, and Wall Street rallied. Kate stock started going higher, and I safely entered the nice position of I think 200-300 shares, and right away I made like $80, and then it went up to $120, but I still didn't sell. I kept it unrealized, which means you're looking at the gain, but you haven't realized it yet, which means you haven't sold it yet. Once you sell it, then you actually realize a gain or a loss. So and then I saw that I made $150 in unrealized gain. I said, okay, I'm doing fine now, and let me just add 50 more shares, and I'm just gonna go to the kitchen and just have some orange juice and eat something and come back to the office. So by the time that I go to the kitchen, exactly as I leave, a story breaks out on CNBC stating that Kate Spade, I mean the financial analysts who were reading more into the thank you and the earning results, they realize that the margins are going to be impacted going forward, and immediately the stock just did a U-turn and began falling while I'm at the kitchen, and I have no stop losses set. I have my stock's at a free fall, and here I am enjoying orange juice, eating a cereal, not knowing, and I'm not listening to CNBC because I'm outside of the office, and I'm just enjoying. What are the odds? What are the possibility of, out of all the stocks in the world, CNBC was going to focus on the one that I'm holding majority at this time, and yeah, so I come back to the office and I realized that Kate fell about 9% already, and I was down about $500 or so. So I said, I kind of read up on what the situation was. I said, okay, Kate is a solid company. It's a multi-billion-dollar company. Worst case, it'll recover in the next 3-4 months. How bad things will get. So I bought another 100 shares at a cheaper price, and at the same time, I sold the call. I sold a out of the money called. And if you're not familiar with the option terminology, please excuse me. Later on, as I give you the basics of the options, what I just told you now will make a little bit more sense. But I sold a out of the money option call to basically decrease my overall cost. So I get a credit. That's a credit transaction, so which means that I get money for selling that option call. And as that happened, Kate actually falls another 2%, and this is like 11-12% or so that Kate has fallen since my purchase, my initial purchase. And at this point I'm down about $800, and I thought to myself, okay, even though this is a great company, even though they're not going bankrupt, this is just a temporary scare, and the market makers are short selling everything, and they're trying to get rid of the weekends and push the stock down as much as possible. I said I'm gonna stick it out a little bit more, but then I realized that there were no buyers at bay. The buyers were not coming back, and I saw this as a potentially a problem that might be my money might be locked for another week or so, and I didn't want that to happen. Do I want to hold on to this loser for another 3 to 6 months and have my money tied up, or do I take a loss now with this $800 and use that money to trade other stocks? So eventually I came to a realization that I should just sell and move on, and as a day trader, that's what I should do. So I took a loss, and that was a lesson learned. I lost a little over $800 or so, but a drop like this hasn't happened in Kate for a long time. I think it was in August of this year, 2014. So if you look at the chart of Kate, you'll know what I'm talking about. It's a drop like you've never seen in this stock, and I happened to be at a time where I was feeling too prideful and I was too arrogant, too full of myself, and I didn't think it would happen to me at that second while I was in the kitchen. And Murphy's Law, everything happened exact same time, and when you think you're doing great and nothing can stop you, and that's exactly when the market's going to humble you. So this was a lesson learned. But the bottom line I'm trying to say is, when you know the financial stance of your company, you understand their product, you understand their sheer size and their investors, then if things like this happen to you, if the stock all of a sudden makes a U-turn and starts falling and everybody's panicking, at least you know yourself the strength of your company. All right, so many of you are going to be trading with at least $25,000 after finishing this course, and some of you might only trade with $10,000. But let me just say that $25,000 is the key to becoming a day trader by Finra's eyes, because if you have less than $25,000, you can only make 4 round trips within a 5 business day period. So it is a FINRA rule. I actually even called and complained, and I wanted to see what's their logic behind this rule, and they said that this is their way of actually protecting the retail investor. And I said, how come? That doesn't make sense to me, because let's say if I don't have $25,000 and I made 3 trades and I really need to do another trade to use this opportunity that I might not get tomorrow, and you're telling me that I cannot trade. I mean, tomorrow I might not have that opportunity that I had today. So, and their logic is basically what happens is people overtrade. They trade too many times, and they just make their brokers rich, and they lose capital. That's their logic, is that if they force you to trade less until you have more money, which is 25,000, then you will take a longer term approach and not lose as much money as you would if you day traded. Because when you day trade, you are competing people who have more than $25,000, and you're competing against market makers and sophisticated algorithm based programs. So yeah, anyway, so I wrote a little tip at the bottom saying that if you have less than $25,000 and you do want to make as many trades as you can, then the best way you can do this is by splitting your account into as many brokers as you can. So you can open one account with TD Ameritrade, you can open another one with Scottrade, Trade King, and so forth. But the problem is, at the end of the year, your CPA is going to hate you, because you're going to have so many 1099 forms. And also you're going to be paying different commissions, and you're going to be using different platforms, which sometimes it can be a little confusing when there's too much going on and you're jumping from one broker to another with different computer screens. So anyway, so that's that. Then let's talk about why we want to trade actively. Just very basic reasons. One, the reason I started off is because I wanted to travel and trade from anywhere I wanted to. That was number one. So freedom to travel and work anywhere from your phone. You can sleep as late as you want to sleep. Of course, you want to make as much money as possible, so you wake up every day. But it's your decision. If you can afford it, don't wake up and don't trade. You don't have to trade a whole month, a year, if you can afford it. So, and let me just say this really quick. When you have a business, and a lot of people tell me, why do I trade a lot? I'm like, well, you know what? Day trading is, to me, it's like a business that I have, but I can close and open it anytime I want to. And it's true, because that's my capital, and I look at it as a business. And I can open it and I can close it anytime. I can work 5 minutes a day if I wanted to, or not work at all and take a long vacation. But when you have a restaurant, for example, you don't have that option. You are hooked for life. And so in this way, when you buy a stock, you actually own the company. You own a piece of the company. So when you buy a stock, you don't do any of the work. The management takes care of the work. The management worries about the shareholders. The management worries about cutting costs and when to open their business, when to close it. You don't do anything. You just provide the money, and then you go ahead and take the stock, and then you take the stock and you sell it 10 minutes later, and then you buy a different company that you like. So it's when you look at it that way, it's a no-brainer, So again, number three, no boss. You don't have to answer to anybody. And if when you do fail, you look in the mirror, and that is the only person that you can blame. That's it. Being in control of your own investments and retirement. That's number one for everybody. A lot of people, they don't trust their financial advisors anymore, and there's all these talks that you might outlive your money, and people need to take a better grasp of their retirement now than to rely on financial advisors. And of course, it is way more efficient to than buy and hold, and those days are slowly coming to an end. Well, um, for investment banking, investment firms, no, that's always going to be the case, buy and hold. But I'm saying for a retail trader, the more you trade, the more you want to make as much money as possible. So there's no sense to buy and hold unless you really want to make sure the entire trend finishes before you jump out of the stock. But of course, day trading is the most efficient and the highest way, the fastest way you can make as much money as possible. So really quick, let's look at this diagram, comparison of what would happen if, let's say, you bought $100,000 worth of stock in 2007 and you didn't touch it, just like Warren Buffett. You just held on to it for a long time. So if you bought $100,000 worth of stock in 2007, you would ride it all the way down with the financial crisis. You would lose about 40% of that, so you would have 60,000 left. And then that $60,000 would gain another 90% over the next 5 years, and you would end up with $114,000 at the end of year 2013. On the right hand side, we have a typical day trader. So as the entire market is selling off, you're actually short selling every day and buying inverse based ETFs, buying option puts, short selling, buying the fear index. So basically you're betting on the short side as the entire market goes down, and then you switch gears and you put on your bull's hat and you start buying stocks on the way up to all the way to 2013. Again, you can do it on a day trading basis or swing trading basis, but the point here I'm trying to make is you're also shorting and going long at the same time. For those of you who are not familiar with those terms yet, long means when you want the stock to go up, and short means that you want the stock to go down for you to profit. Longs are the bulls and short sellers are the bears. And a little history behind that is because the bulls, they hit you with their horns, you go up in the air, and the bears hit you with their paws and bring you down. That's the whole logic behind that. Alright, so as you see, if you traded actively in a counter-cyclical fashion, which means you're going to be trading short and long, from 2007 to 2013, you could have turned that $100,000 into $266,000. Granted, if you, instead of losing 40%, you made 40%. Again, so this is one way that you can see that buy and hold sometimes is useless. Even with the real estate, there are a lot of people that actually bought a house and right before the crisis, and then the home values tanked, and then they recovered about 7 years later, and now they're back to square one. So they're barely breaking even now, and it's as if they never bought a house in the first place. So in the same situation, there's a lot of stocks that it takes them like 8 to 10 years to recover from their new low that they've made during the crisis. Alright, so first thing I like to do is I have people think about this concept. I ask a question: would you rather drive a Maserati and work on weekends, Or would you be content just having a bus pass but being fully retired? You would be amazed how many people would pick the Maserati and working on the weekends rather than be fully retired and just having a simple life, even taking a bus if it means to be retired. So, a little bit about me. I would pick the latter, as I said, and I said goodbye to the 9 to 5 at a very young age, and that's mainly because I reduced my monthly expenses. I improved my trading skills, but my first and foremost thing to do was reduce my monthly expenses. I started looking at my girlfriend as an expense also because on a monthly basis I knew exactly how much it would cost me, and I said, what's really important in my life is for me to get to my goal, and if people deter me from my goal, then I just cut them out of my life immediately. I didn't care about what the society thinks or how it should be. No, what it should be is first things first, you get your finances under control, you build your life, and you save money, you start investing, you simplify your life to a point where you become rich, and then you can complicate your life again. So, upon migrating to this country at age 13, my main supporters were my mother and my older brother, and they were living paycheck to paycheck to support me the whole time, and they didn't speak a lot of English either. Um, and they are still working. My brother is a banker, and they think what I do is gambling to this day. So, to each its own. I was a little bit about me. I was born in Yerevan, Armenia in 82. I lived in a lot of countries from Armenia, Russia, Kazakhstan, and now US. Um, got my bachelor's degree in finance from UTSA, and I had a lot of jobs in my life. I had about 14 jobs, and I've been laid off. I've quit, and I got tired of the rat race. It's just the corporate life was not for me. It's just I number one, I couldn't be caged in a cubicle, and I don't know if you guys seen movie Office Space, but I completely understood that everything that was said in that movie, and I agreed. And it just I got burned out after a while, and I'm glad I started trading very early on, and I got to fail and then get up again. But every time I would fail, it would it would force me to go back to the 9 to 5, save money again, and then try it over and over and over. And even then, a lot of people don't make it because they are too stubborn, they have too much ego, and it's really hard to adapt and slowly develop this skill which will pay you forever for the rest of your life. Um, I've also written before. I've written a lot of articles on Motley Fool and Seeking Alpha, but I stopped writing recently. But I might pick it up later. I don't know. But I used to do it for fun. I loved it. I loved talking about companies. I loved dissecting large corporations and digging into the 10K and financial statements, and it was just great. I had a good time. So yeah, I've been trading for about 14 years. I The first few years I paper traded, and then like I said before, I made my first stock trade in Blue Dolphin Energy, and I made a lot of money, and I was hooked. I mean, a lot of money back then. $1,000 was a lot of money for me. I had my first job at making what $14 an hour, and so that $1,000 in a few minutes was ecstatic. So over the course of the 14 years, give or take, I made a little over 50,000 trades. I haven't been counting, but that's the range when I break it down. There are days I make 150 day trades in one day. On average, I make about 80 to 100 trades a day. On a slow day, I'll make about 30, 40 trades. So in the last 4 years, I made about 118% average annual profit, which is fairly good. Some years better than others, Actually, during the financial crisis, I made a lot of money just on option puts. And Bank of America and Countrywide deal, that was one of my biggest gainers. And then when Bank of America was trading for about $4, I bought a lot of option contracts, calls, and then I exercised them and I held on to the shares and rode them all the way till 13. And then I traded it on and off until from 13 to 16. So it's just a lot of experiences, a lot of gains, a lot of losses, but over time, I would say my last 5 6 years was phenomenal. Yeah, and then I like to talk about how great single life is. I've had you know a lot of relationships in my life, and most of them didn't work out. Some of them worked out, then I got tired, but most of them didn't work out because of my trading. And when you trade, it's like um, even the smallest things can get on your nerves. If you're glued to your computer, you're reading articles, you're looking at the CNBC, and you're just dissecting all this information, and you have trades going on. You have all these things you're thinking about, different stocks, what to do, and then your girlfriend calls and asks you a question and wants your attention right there and then. And there's a couple of times, I won't lie to you, I completely lost it. And yeah, I just started cussing her out, and that was it. And that was one. So I've had instances where I would throw things at the wall. I've had get so pissed off that you want to go and break things. I actually made a special breaking room at the house where I smash watermelons and get my anger out if I'm having a bad trading day. So, what I'm trying to say is it takes a special person to be with an actual day trader. And day traders are a very unique type of people, and not everybody can handle their mood swings sometimes, or their unique personality. Excuse me. So, if you can find somebody who is a day trader, by God, keep them, because that's a match made in heaven. Um, Sadly, I haven't been able to find somebody that is beautiful and loves day trading. Those two things haven't been matched yet, but I'm still optimistic. So I'm gonna tell you straight up that your life partner will either be a drain on your finances or be a contributor. So choose wisely. Don't marry a gold digger. Don't go do stupid things with your money. Don't go waste it on just vanity. Especially for your girlfriend. And I want to say this quote I like: "Money isn't everything, but it's almost right up there with oxygen." And it's true, and money is not everything. Health is. I do admit that, but uh, I mean, everything you do revolves around money. So it is almost right up there with oxygen, and we as society place a major emphasis on it since 16 years old. You're already pushed to go get your first job. So it's all about paying bills, getting a student loan, buying a house, getting a mortgage, being constantly in debt. So, and then paying your taxes every year. So you're constantly bombarded with money issues since you're born. And then, yeah, and I asked the people in the class to share their story, but since I cannot hear your story, you're more than welcome to email me and edgarstockpicks@gmail.com and tell me your story. I'll be more than happy to read them. So I want to talk about preferred trader attributes. Um, these attributes are are real good qualities to have. They're not necessary, but it's preferred if you have these qualities. First and utmost, disciplined. You know, you have to be disciplined like a military person. Okay, there's absolutely no time, or there's absolutely no room for excuses. You know, basically, if you make an excuse and say, "Okay, I'm gonna wake up at 6:32 a.m. instead of 6:30 a.m., well, guess what? You just lost a lot of money. Okay, when it means to wake up at 6:30, it means to wake up at 6:30. The stock market is not going to wait 2 minutes for you to roll out of bed. Okay, as a matter of fact, you need to wake up 30 minutes early each day. So I'm talking about West Coast time, so 6:30. So before the stock market opens, I strongly suggest you wake up 30 minutes to an hour early than that, because first you have pre-market trading hours, which you can start trading even before that. But usually you get up that early, you kind of freshen up, get a coffee, and you start reading the articles. You try to gauge the market sentiment, get your charts together, make sure you see what the volume is, which stocks are actually starting to move, is there any news announcements that are worthy of looking at, and just get a feel of the market. So that takes about a good 30 minutes. So the next thing is being punctual. Again, it plays along with discipline. Being punctual is a major thing. I actually, one of the jobs I had was in FedEx, and at FedEx, if you're late 2 minutes like 3 times, you're fired. That's it. There's no excuse, because the entire model of FedEx is to deliver everything on time. So even the employees there have to be on time. I mean, talking about by the minute, because the containers are shipped to an airport, and then the truck driver needs to wait exactly on his time, and then he takes the packages to the airport, and so forth and so forth. Everything's on time. So again, punctuality is extremely crucial. Next thing is egoless personality. This is very hard for men. A lot of men think, oh, okay, women are not good traders. I disagree. Women, even though they're more, they're emotional creatures, but they are better traders than us, in a sense that they don't let their ego get the best of them. For example, a woman is much more prone to ask for directions outside than a man does. The man always wants to do things himself because he knows it better, he does it better, and we're actually programmed to be that way sometimes, and sometimes we have to let that slide. Especially in the market, you need to understand when you're wrong, admit it that you're wrong, and move on quick. You better adapt and move on and join the herd and join the majority, or you're gonna be asked out. There's no time for people to realize that you're right. You could be right, and that's fine, but you're wrong even though the market's right. Meaning, if you're right and the majority is wrong, but they're the majority, that makes them right. Because if everybody sells, then you're gonna sell too. You're not gonna sit there, hold the stock thinking, oh, okay, this stock actually is worth more than I think it is, and you just hold on to it while everybody else is dumping. So sometimes these panics are not warranted, and they can destroy your capital. And then if you panic later than that, it might be too late. And again, it's kind of vague talking about this. Specific scenarios, specific stocks would be much better. But I guess you're getting the gist of what I'm saying. Next, being humble. Being humble is very important too, because when you're not humble, you think you know everything, and that's exactly when the market teaches you a lesson. The market will force you to be humble. When you stop being humble, that means you're making a lot of money, and you get on that mentality that nothing can overthrow you. And that's that same Kate example that I talked about earlier, is where I made a couple $100 after earnings, and I went to the kitchen. I was like, okay, I don't need to put my stop losses, I'm fine. And that's exactly what happened. I was not humble, and the market taught me a lesson. being a realist and non-religious, having a non-religious view is fairly important in the markets. I think that um, when you when you take an approach of a realism, then whatever your eye sees, then you believe. First of all, you perceive. So if your eye sees something, you perceive it. Unless you're on LSD, but in this situation, you see something, you perceive it. So you see a stock going down, you see trends changing, then you react immediately and you say, okay, now I'm gonna go on short sell, which means everyone's gonna be in panic now. Fear is sipping in, and it's gonna be a major sell-off. Boom, you lose your ego. You were wrong. Now you're gonna try to short sell. However, if you come from a religious background, then you have a false sense of hope, and everything's gonna be fine and dandy. It's all gonna be peachy. It's gonna be all roses. Everything's gonna be great because you've been a good person your whole life. And just watch. Market's gonna recover. I know it. This stock is good. It's gonna be great. You're not gonna last in the markets if you come with that mentality into the markets. I'm just being realistic with you. There's a lot of sheep out there, and a lot of the people that come into the markets thinking, oh yeah, it's great, American stock market's always going to recover, it's going to be, good times are coming very soon, very soon. If you come with that mentality, that's an investment mentality. But if you want to be a day trader, if you want to make money on consistent basis, then you need to do a better job at detecting fear and detecting the right pivot point of optimism and pessimism. And when the market sentiment changes, you need to do a better job at assessing the situation and becoming a bear and not a bull, and vice versa when it changes again. So being a realist and being non-religious, it actually helped me seeing the market the way it is, not questioning it, and acting on it. There's going to be a lot of things you're going to experience, a lot of manipulation, a lot of scandals, accounting scandals, a lot of news hype, a lot of exaggerated overvaluations, like with Tesla we saw, non-GAAP earnings, or we saw the Alibaba IPO come out, and it was not an actual company that you can own, but it was actually a variable VIE, variable interest entity, that it was based out of a different corporate structure in a different island. I don't know. So there's a lot of crap that comes with the markets, and there's a lot of different opinions, and there's a lot of different news sources, pundits, financial analysts, all are pulling information in different direction, and they're pulling the stock price in a different direction. So your job as a trader is also to dissect all the bullshit and understand what really is going on with the stock. Make your own, do your own due diligence, read your own financial statements, sit there and listen to the conference call. Make sure you analyze everything, and then make your sound decision based on not factual data alone, but also your own common sense. So in my humble opinion, I think people who are spiritual, who are realists, who are non-religious, who are not Bible thumpers, actually do a better job in the markets. That's all I'm saying. And I hope I didn't offend you, but if I did, I do apologize. A critical thinker is a person who questions a lot of the information that he's being told, whether it's media outlets, whether it's financial analysts. It is very important to ask your own questions, and make your own sound decision based on your logic, based on your own way of thinking. For example, um, there's a lot of money that's sloshing around in the illegal industry, like the black market they call it, underground market. Underground market is a $2 trillion market. That's, there's money in drugs, guns, you name it. So there's a lot of corporations that receive revenue from those um, business exchanges. For example, Harley Davidson sells a lot of Harley Davidsons to biker gangs, and biker gangs, let's say, make their money from crystal meth, right? So from crystal meth, that money flows to Harley Davidson's balance sheet and net income statement. So if you realistically think about it, that's what happens. Um, a lot of money is being laundered into American corporations from drugs. Another example is, for example, a stripper who's making money in cash takes that cash money and goes and buys a home from KB Homes. Now, KB Homes just sold a $220,000 house in Palm Springs to a stripper who purchased it cash. And that's it. That money that came maybe from drugs, maybe from guns, came into the strip club, and from the strip club, it came back to KB Homes' balance sheet. So um, there's things that are out there that news is not going to talk about it. Your average financial analyst or a CFA holder is not going to talk about it. They cannot even mention it because of a fear of being sued. But these are things that you need to think outside the box and see where the money is flowing and what is true and what is not true. When you're traveling, when you're going places outside, just make sure you keep your eye on companies. You make sure you look at different restaurants. You're in a restaurant that has a stock symbol that you trade. Go out there and ask questions. Ask questions to the managers. See how many customers they have. What's going on. My eye is always looking at new products. Who made them? Are these companies public? I'm always looking at new companies. And when I go and eat at restaurants, I already know the restaurant I walk into. For example, Darden Restaurants that owns Olive Garden and Red Lobster. I already know their current market cap size. If I go to Crocs store, I know how much Crocs stock share is. I know what products they sell. I'm always interested to know what's coming soon. I go look at Michael Kors. I see a huge line outside of Michael Kors, but their sales are dwindling. Why is that? Well, Michael Kors is now forcing women to stand outside to come into their store when the store has, let's say, 10 to 15 people. They don't want the store to get too crammed. Plus, they're creating a buzz by having a club line, like a velvet rope club, dance club line form outside. So it creates a buzz, and people are like, "Oh, what's going on, Michael Kors?" Well, not much. It's just they can only allow up to, let's say, 10 people inside of the store. So always be out there. The stocks you trade, look what the company is doing. Just ask questions and be a critical thinker. And the last one is being unlucky. this was a interesting one and I put it in there because honestly, I was never lucky. There was absolutely nothing that came to my life with luck. I heard that Irish people are not lucky also. I know maybe I was Irish in my past life, but everything I worked for, I got it by through hard work. Nothing came easy for me ever in my entire life. And the more I worked hard for something, the more luck I got, the more lucky I got. Now we are officially beginning this course. Let me state again that part 1 is going to be the easiest out of all 4 parts. And won't need a lot of note taking, so you can go make your popcorn, get a soft pillow, and get all cozy on the couch. If during the course I use Wall Street lingo and terminology, or I throw around concepts or strategies that are not familiar to you, then you can watch this course again and again until it all starts making sense, and it will eventually. Also, the more you trade, the more you will understand some of the risk management techniques and different scenarios that I'll be referring to throughout part 2 and 3. Let me also state that there are quizzes for each part which you may take to test your knowledge at the end. Alright, so for part 1, we're going to talk about the US economy, building blocks of capitalism, the importance of lenders versus borrowers, because our entire economies are based on those two categories of people and companies. The stock market basics, the indices, sectors, industries, our shareholder rights. What does it mean to own a stock, and what type of rights do you have as a shareholder? Volatility, we're going to talk about risk, earnings per share, price to earnings multiples, and I'm going to show you a model portfolio of how a hedge fund manager would allocate $1 million in how diversified he would be in that scenario. Also, we'll talk about how to choose a discount broker that is optimal for what you're trying to accomplish. Alright, and then part 2, which will be the most grueling part if you don't love numbers and simple algebraic computations, is fundamental analysis. We will learn how to read financial statements and evaluate a company just like financial analysts do. We will learn to perform a discount cash flow analysis to calculate an intrinsic value of a stock price, or at least come close to it. You will learn how to input different variables into the DCF formula based on various economic scenarios such as recession, expansion, stagnation, and so forth. And then part 3 is the bread and butter for day traders and swing traders, where fundamental analysis uses financial statements and formulas to calculate a stock price. Technical analysis is a method of evaluating securities by analyzing statistics generated by market activity. Instead of computing an intrinsic value, you can use charts and other oscillators to identify trends and patterns that will suggest future activity of a stock price. So a best way to describe it is, let's say in a shopping mall, a fundamental analyst would go to each store, study the product that was being sold, and then decide whether to buy it or not. By contrast, a technical analyst would sit on a bench in the mall and watch people go into the stores. Disregarding the intrinsic value of the products in the store, the technical analyst's decision would be based on the patterns or activity of people going into each store. So that's, I guess, the best way to look at the difference between the two. Lastly, in part 4, I will talk more about the Edgar's method, which I have developed and used after becoming more conservative throughout the years. The Edgar's method combines fundamental analysis and technical analysis to gauge an initial position size that is suitable for a particular stock with a particular market cap. So when you choose a stock and you decide to buy it, you will use the Edgar's method to tell you how many shares you will purchase and will you add more later or bail completely if things go against you. So this is the main problem that every beginner runs into, is not being able to predict the future, and when things go south, a trader freezes in an indecision between those two choices. So the risk and reward profit is a diagonal looking chart which trends upwards, as you can see. So on the bottom we have the risk, and on the y-axis, vertical axis, we have the profit. So basically, the more risk you take, the more money you should be compensated for taking that risk. That's why the chart looks like that. So starting at the very bottom, you have treasuries and certified deposits, let's say, which are practically risk-free, but they do have some minute risk to it, so hence their yield is very low, between 0 to 5%. And then the next column is more riskier investments, such as mutual funds, that offer even a higher yield in the range of 5 to 10%. Then we go up to the third column, which is, let's say, small to large cap stocks, which have the ability to yield 10 to 25% a year. And then lastly, we have options, which give you much juicier gains, but at the same time can crush your portfolio if you used it to only speculate. Options could be a great thing for your portfolio if you want to hedge it against insurance, but if you merely speculate on them, they can actually destroy you if you're not that knowledgeable in computing the Greeks and understanding the intricacies of trading options. So I would take it even a step further and say that penny stocks would be the next in terms of risk that can gain you 100% or completely eradicate your portfolio in a couple of days. And if you think about it, everything in life is risk, right? If your job requires cleaning windows of skyscrapers, then the pay will be great, because the risk is also great, since not too many people will be up to the task. Or another example is when major rap stars who are millionaires now, they first sold drugs, right? They first sold drugs in the ghettos, and then they used that drug money to fund their rapping careers, and then they went legit. So they took the risk of going to prison for a long time. They also took the risk of getting killed. Hence, why they were rewarded by the large profits made in the cocaine industry. So anything in life is a risk. You want to take a higher risk, you will get rewarded for it. So if you go taking a lot of risk and then destroying your portfolio, that's how you learn. In a sense, you will always cross that threshold of you taking more risk than necessary and then getting burned, and then the market teaches you a lesson, and then you become conservative. Every single trader has gone through that process. So the risk and reward can be a double-edged sword, because everyone wants to make as much money as possible, right? So the risk and reward relationship is a very tricky one, because you want to take more risk when the market conditions are great, and you want to take less risk when market conditions are dismal. And if you don't get that part right, you will incur some hefty losses. And the same thing could be said about playing poker. If you have a good hand, then that's low risk. So you should go ahead and bet. And if you have really crappy cards, then you're taking a very high risk at trying to bluff your way through and try to basically win the other guy's money. All right, so now let's jump into the economy and talk about a master versus a slave. And of course, I'm talking about a modern slavery, but I get a lot of people pissed off when I start talking about slavery, and people take it the wrong way. But I'm sorry, this is exactly how I see our society nowadays. The only difference between the old slavery and the current slavery is right now you're a slave to the dollar bill, the dead presidents in your pocket. And the marketing majors will make sure that you keep spending money that you don't have, and that our savings rate for our economy stays as low as possible, so that people will continue to spend and borrow, hence always continue to work for 40 hours a week. Everything's already thought out. So, and it's all interconnected together. So, a good capitalistic structure will have two set of players: net lenders and net borrowers. So I asked people is, which side are you on? Are you a landlord? Are you a renter? Um, or are you both? For example, I am both. I have a property in Costa Mesa that I rent. It's nice apartments. I rent it, and I also have house in Texas. So um, doesn't necessarily that you should always try to be a landlord, and but based on your circumstances, you just want to make sure that you're not throwing away money every month that you could have used it to build a nest egg or invest in a property that will generate you a monthly cash flow. And this is not just towards people, but you need to understand that companies themselves, even though they have billions of dollars on their balance sheet, they also need to borrow to expand. So whether it's a person or whether it's a company, they are divided into lenders and borrowers. And you have personal credit cards that you actually put your purchases on, and companies that have their own credit lines and they have their own loans and they issue bonds. So our system is just this complex mechanism that just borrows from one another, and the money just flows and circulates from one entity to the next. So most corporations will borrow in order to compete, survive, and grow their operations. So it's all about growth. Every public and private company tries to maximize the value to their shareholders by growing their net income. So by their growing their operations, they need to expand, they need to acquire new plants or new businesses and continue to grow. And when they stop growing, of course, the value of the shares decline. So every company goes through these phases of development and then expansion, then maturity, and then a slow decline after it has reached the maturity phase. And what happens is when a company reaches its maturity phase, at the same time, the analyst expectations of that company earnings also rises. So what I'm trying to say is that earnings per share becomes more sensitive. So one small imperfection can tumble a stock after an earnings release. And we'll talk about that more in the future. So under the second bullet point, you see I have FB equals middle class. FB is the stock symbol for Facebook. And Facebook, their growth is pretty much tied to the middle class consumer. Meaning in China and India and all these developing countries, every time a family, let's say, goes from poor class to middle class, and they're able to afford a computer or a laptop and they can get internet access, then most likely Facebook will definitely benefit from having a new member. And then same thing with, let's say, on CMG is Chipotle. So Chipotle has grown phenomenally in the domestic markets. Now it's trying to tap into the international markets. And when you look at that sheer power of how much CMG can grow in Europe and Asia and Canada even, and you compare that to, let's say, KO, which is Coca-Cola, who doesn't have much growth left because they're almost in every country. Every person knows about that company. So, and Coca-Cola is not growing as fast, primarily because the world population is actually shrinking in terms of the growth. The growth used to be about 3%, and now growth population is only 1%. And having said that, there's also another factor which is affecting Coca-Cola is a lot of people are becoming more health conscious and they're not drinking soda as much. They're sticking to water or any other healthy alternative. So, of course, there's different factors that dictates whether a company is going to grow as aggressively as it did before. Um, I wanted to jot down some primary drivers for those three companies: Facebook, Chipotle, and Coca-Cola, and how they're trying to combat their growth problem. So for example, Coca-Cola, let's say, might switch to producing more other items. I don't know, more edible like chips, and maybe get into the vitamin water business to try to retain and capture as much market share as possible. And who knows what will Chipotle do in the future after every country, knows about Chipotle and loves their food, or maybe changes to another brand. But it's very interesting to see how every company goes through these major phases, and how consumers sometimes dictate, not sometimes, but all the time, they dictate of what they want. If the consumer shifts to organic food, then you're gonna see Walmart trying to cater that demand and shift into the organic business, and definitely impact Whole Foods' market share. And then the credit system, just like me, you have credit scores. Our credit scores can be seen in the three bureaus: Equifax, Experian, and TransUnion. And the same way, companies have their own credit score, and they can be accessed through Dun & Bradstreet, Moody's, and S&P. Dun & Bradstreet does a lot of private companies as well. So, and then Moody's and S&P is mostly for public companies. And last bullet is, we already talked about that, the savings rate must remain low for us not to fall into a recession. Hence, majority need to stay in debt. When a lot of people come to this country and they start saving, okay, and that's what happens. The savers are the immigrants. They come to this country, and a lot of them, they do want to save as much as possible, but at the same time, they also have a lot of expenses until they get to a wealth level where they have a house, they have a nice car, and they're tired of the materialistic lifestyle, and they want to start cut down and invest. So me as an immigrant, I went through a lot of phases of splurging and then saving and then thinking about the future and cutting back on the expenses, as I stated earlier. But definitely, if you look at the different classes in the United States or the world, globally, you can see that the richer you get, the more you save, because how many boats and how many cars can you have, and how many houses do you really need? Of course, a lot of wealthy people feel that they still need to splurge and still need to compete with their neighbors who are also rich, and belong in the same country club. So, I'm going a little bit off topic, but the main concept here to remember is that the poor and the middle class spend the most. Pretty much everything they get from their job, they end up spending. And whatever they can tuck away in their 401k fund, that's pretty much what stays after years of working for a company. And in capitalism, you you always have these periods of recession, and sometimes it turns into a depression, as we saw in 30s. So every time there is a major recession, what happens is the gap between the rich and the poor becomes even wider than it was before. one interesting fact that I forgot to mention is I just read an article that in China, for the first time, Chinese are actually buying cars with credit. You know, all this time, and not just China, in Armenia too. Um, a lot of people they just buy things with cash, and that's just how it is. The credit background is not so sophisticated where a bank can lend you money to go and buy something. So whether it's real estate, whether it's cars, everything was paid in cash. So it was interesting to see that there's a huge trend in amongst the Chinese that now they're buying cars with credit, which will definitely, I think, supercharge their economy going forward. Um, and in my opinion, I think within 5 years, China is going to be the number one economy, with U.S. being number two. It's just a matter of time. Most analysts were saying that, oh, it's going to take 15, 20 years, but I think it's going to happen way sooner than that. So again, when there is no growth, investors will sell the stock and move on to a company where there is more growth. Makes sense, right? You want your stock to go up, so you're going to sell it and you're going to go and buy something else that's going higher. So this is why managers get fired when they don't outperform their competitors. And business is viewed to be a very cutthroat environment, since everything boils down to growth. And if you've worked in a company, which I'm sure you have already, you know exactly how it is. Every 3 months, there is an earnings release, and basically the managers are always trying to cut costs. And at the end of the year, if they've done a poor job, then most likely the CFO comes and says, okay, we're going to make all these cuts and we're going to lay off all these people, and we're going to start fresh with new ideas, new way of doing things. And unless everything's working fine and they have grown and reached their targets, then of course they might leave things as is. Okay, so let's look at how much debt our country has. Um, Again, these figures are not exact to the T, but they're fairly close from the last time I checked. So we currently have 17.6 trillion and 200 billion in our debt. And this is United States debt, out of which China owns 1.12 trillion, Japan owns just as much, 1.1 trillion, and other foreign investors own $2.8 trillion. And the US public owns about $12.6 trillion. So when you hear those rumors that, oh, China owns us now and all this stuff, tell them to look at these figures, because China doesn't own us. China owns $1.12 trillion of our debt, which is a lot. I'm not gonna say it's a small figure, but it's a huge chunk of our debt. Majority of our debt is owned by the U.S. public through T-bills, treasury bills, notes, bonds, Social Security, etc. Our gross domestic product in 2013 was $16.8 trillion. Now think about it. Our debt composes 95% of that. I'm sorry, our GDP is 95% of our total debt. That's terrible. I mean, in my eyes, that's horrible. This is actually the same reason why I don't want to have kids, because I know that our kids are gonna pay the price for this. They're the ones who are gonna pay higher taxes. So let me not jump the gun for a second. There's only two ways that this debt could be reduced. One, higher taxes, or two, budget cuts. So, every politician, that's exactly what they talk about. Higher taxes or budget cuts. Most likely, it's going to be higher taxes, because they can there can only be so many budget cuts that you can do, and it's not even a drop in a bucket of uh, turning this entire 17.6 trillion around. It's gonna take decades. Okay, so when I look at this statistics, being rich is not an option anymore. It's a necessity. The gap between rich and poor will widen even further in the long run, especially for your kids. So a lot of people they don't think about stuff like this. They don't care. They just marry and they have kids. They can care less, or they don't even understand what's gonna happen to their kids' future. They're just enjoying their life right now today, completely disregarding our future of our economies and the global stance of um, everything from drinking water to our economic climate, um, or whether our planet will be able to handle 10 billion population by year 2060. I mean, is there going to be enough food for everyone? So nobody really cares about that, and I shouldn't say nobody, but majority of the people don't care about those type of issues. So the reason I think that people don't focus as much on the wealth gap is because life has become much easier than it was before. There's a saying that rising tides lift all boats, meaning the standard of living for all people rises when the economy is doing phenomenal, and businesses are making money and the rich is getting richer. And because of trickle down economics, the poor are also doing better than they did before. To some extent, I agree to that. Um, I mean, right now, even the homeless people have cell phones, right? You didn't have that before. So you can thank Walmart, okay, Walmart for having the biggest impact on our society, positively and negatively. I mean, Walmart is such a giant, and it has so much pricing power that that's the only way it can sell its products for dirt cheap. And so even the poor people, they have everything they need, and they can buy it for really cheap because of what Walmart is doing. But at the same time, a lot of people don't want Walmart in their communities because it pushes away the smaller business that tries to compete, basically is not able to compete at all. Um, so that's the issue there. Another thing is cars. Think about cars. Cars last longer now. They say average person changes cars about 5 to 6 times in their lifetime, but now, I'm sorry, before it used to be 7 to 9 times, but now average person changes its cars 5 to 6 times in his lifetime. So that trend is also changing. People eat less and are more health conscious. Everything is paperless in this digital world that we live in. So that saves a lot of trees. Think about all the trees that internet saved. Um, so all these changes, I think it gives us this illusion that we are better off. But I think financially speaking, we are actually worse than before. You know, we just don't realize it because we're distracted with so many options, from YouTube videos to Facebook to cell phones. People are always distracted. But at the end of the day, um, more people are in debt, which means, again, more people will need to continue working at their jobs. And many retirees now are planning not to retire because they simply can't afford it. And because people are becoming more health conscious, they're also going to live longer. So recently I saw that commercial of, I forgot which company. It said, "Are you going to outlive your money?" And that's going to be the new trend with baby boomers. And it's just going to create a lot of problems. Whether are we going to have a lot of money left in the Social Security, and are we going to raise taxes again because of that? So all that jazz. Many of you have probably wondered how much our government pays in interest expense. You know, just like you pay interest on your mortgage and your car, on that beautiful $17 trillion debt that we have a interest expense to pay to the debt holders. So these figures are derived from treasurydirect.gov if you want to check them out. So in 2013, interest expense that we paid was somewhere around 30 to 45 billion a month. So imagine what will happen if our credit rating drops by Moody's or S&P. You know, at one point S&P was contemplating to downgrade United States. So think of what happens to your credit score if, let's say, your score drops. When your score drops, you get charged a higher interest rate by your lenders, and in return you pay a higher interest expense. So the same thing with our economy. So let's say if our credit rating is downgraded by Moody's or S&P, then our debt holders are going to require a higher interest. So imagine now we're already having a tough time paying our current interest expense. If we get downgraded, then definitely these figures that you see on the chart are definitely going to be higher than they are now. And I don't know what the figures are for 2014, but that would be a good exercise for you to look into it and do some investigation and get back to me, or don't get back to me. I know I'm not looking at these figures anymore because I just get depressed every time I look at them.